For decades, Japan was America's most reliable financial partner, quietly buying up U.S. Treasury bonds and playing a crucial role in stabilizing the U.S. economy. By consistently investing in U.S. debt, Japan helped support the dollar's global dominance and ensured smooth functioning of international markets. This relationship was a pillar of the global financial system, with Japan holding more U.S. debt than almost any other nation, second only to China for many years. But now, Japan is stepping back from this long-standing role, signaling a major shift in global finance. The country is systematically reducing its massive holdings of U.S. government debt, a deliberate and significant policy shift that has caught the attention of economists worldwide. This signals a profound change in how Japan views its economic future and its relationship with the U.S., reflecting new priorities and concerns. The implications are enormous. When a country as important as Japan starts selling U.S. debt, it challenges the belief in the dollar as the world's ultimate safe haven asset and raises questions about the future of global reserves. The steady selling from Tokyo is creating ripples in financial capitals worldwide, prompting investors and policymakers to reassess their strategies. Japanese policymakers are increasingly worried about America's growing debt, rising interest rates, and the long-term stability of its currency. As a result, they're taking steps to protect their own economy, seeking greater financial security and independence in an uncertain world. This move is not just a financial transaction. It's a declaration of economic independence and a signal that Japan is ready to chart its own course. The world is watching to see what Japan does next, and why, as every decision could have far-reaching consequences for global markets. For years, tying its fortunes to the U.S. economy was seen as the safest bet, a strategy that brought stability and growth. Now the calculus has changed, and Japan is rethinking its place in the global financial order. Japan's quiet exit could reshape global finance for years to come, influencing everything from interest rates to currency values. The era of predictable financial cooperation is ending, and a new chapter in international economics is just beginning. The driving force behind this shift is Prime Minister Sanai Takaichi. Since taking office, Takaichi has championed economic self-reliance, arguing Japan can't afford to be so dependent on the U.S. Her administration is diversifying Japan's foreign reserves and reducing exposure to U.S. economic shocks. This is a sharp break from previous policies that prioritize the U.S. alliance above all else. Takai's government believes that blindly holding U.S. bonds is no longer prudent. The Takai pivot is more than a financial maneuver. It's a political statement of independence. Japan is now asserting its right to make economic decisions that prioritize its own stability. The world is taking notice as Japan forges a new path. Japan's loyalty to the U.S. dollar was once unwavering, built on shared security and economic ties. But trust is eroding. Japanese officials are alarmed by America's soaring debt and political dysfunction. The once unthinkable prospect of a U.S. default is now quietly discussed in Tokyo. Japan's massive investment in U.S. bonds is starting to look like a vulnerability, not a safe asset. Political battles over the debt ceiling and aggressive monetary policies have made Japanese investors nervous. The focus has shifted from supporting an ally to protecting Japan's own assets. Japan is now acting more like a pragmatic investor, carefully weighing risks and rewards. The cracks in financial trust are visible, signaling a fundamental realignment. The old certainties are gone. Japan's divestment from U.S. debt began quietly, with small, almost unnoticeable sales that barely registered on the global radar. At first, these moves seemed like routine portfolio adjustments, easily overlooked by most analysts and market watchers. But under Prime Minister Takai, this slow drip of sales transformed into a clear, deliberate, and official policy shift. The government made it known that this was not a temporary measure, but a strategic decision. Top financial officials began speaking openly about the need for diversification and the importance of reducing risk in Japan's foreign reserves. They emphasize the long-term benefits of spreading investments across different assets and regions. Soon, U.S. Treasury data revealed a consistent, significant decline in Japan's holdings, confirming that this was more than just talk. It was a sustained trend. The sales became larger and more regular, sending a clear message to the world. Japan is serious about reducing its exposure to U.S. debt, and it's not looking back. Global markets reacted with concern and uncertainty, as the departure of such a major buyer from the U.S. Treasury market raised questions about future demand and stability. The official confirmation of Japan's new policy sent shockwaves through the financial world, sparking urgent discussions among investors, policymakers, and economists worldwide. Today, Japan's strategy is no secret. The numbers and public statements from officials make it clear for all to see. The scale of the reduction is now impossible to ignore. What began as a slow drip has now become a steady, unmistakable outflow, and its full impact on global markets and international relations is only beginning to be understood. The world is watching closely, waiting to see who might follow Japan's lead, and how this bold move will reshape the future of global finance. Japan's decision to sell U.S. debt was triggered by American policy choices. New U.S. tariffs on Japanese goods created friction and undermined trust. At the same time, America's ballooning national debt raised alarms in Tokyo. Political battles over the debt ceiling added to fears of instability. The combination of trade disputes and rising debt pushed Japan to reconsider its reliance on the U.S. Diversifying away from U.S. bonds became a defensive move. The risks of holding so much U.S. debt began to outweigh the benefits. U.S. domestic policies had unintended global consequences. Japan's exit from U.S. Treasuries poses real risks for the American economy. The most immediate impact: higher borrowing costs for the U.S. government. With Japan gone, the U.S. must offer higher interest rates to attract new buyers. This means more expensive borrowing for everyone: government, businesses, and consumers. Economic growth could slow as loans and mortgages become pricier. Japan's move also undermines foreign trust in the U.S. financial system. If other countries follow, demand for U.S. bonds could fall further, creating a vicious cycle. The global financial system, built on U.S. Treasuries, faces new risks. The era of endless foreign capital may be over. The U.S. can no longer take its privileged position for granted. Japan's recent financial maneuvers closely mirror a strategy that China has been steadily pursuing for years, reducing their heavy reliance on U.S. debt and the American financial system as a whole. Both nations are actively searching for safer, more diverse ways to invest and protect their vast national wealth, aiming to shield themselves from potential shocks in the global economy. The underlying message is clear. Being overly dependent on the U.S. dollar exposes their economies to significant risks, especially in times of uncertainty or geopolitical tension. As a result, both countries are steadily increasing their gold reserves, viewing gold as a timeless and reliable store of value that transcends political and economic shifts. Unlike paper currencies, gold cannot be easily devalued by government policy, making it an especially attractive hedge against inflation and currency instability. In addition to gold, Japan and China are also diversifying into other major currencies, such as the euro, to further reduce their exposure to the dollar. This trend is part of a broader movement among the world's major creditor nations, who are all rethinking their strategies for safeguarding national assets. The world's largest savers are now actively seeking alternatives and planning exits from the traditional US-centric financial system, signaling a major shift in global finance. Even though Japan and China are often seen as rivals, both are independently pursuing remarkably similar paths to financial security and independence. Their deep concern about the future stability of the U.S. economy is driving these bold moves as they prepare for a world where financial power is more widely distributed. If Japan and China are reducing their U.S. debt holdings, who will fill the gap? The U.S. has long relied on these countries to finance its deficits and support the dollar. Now, the foundation of this system is shaking. More nations are reducing their dollar reserves, seeking a multipolar financial system. The U.S. may lose its exorbitant privilege of cheap borrowing and global dominance. The era of easy money, funded by foreign creditors, may be ending. The world is entering a new, uncertain financial era, and America's role is now in question.